Hello, welcome back to Miss Finance. On this video I go through all things accounting, finance, investment related, so if you like this kind of stuff do consider subscribing as always. But let's get straight into the video. So I thought I'd talk to you today very quickly about internal rate of return, otherwise known as IRR. Now when you look into the books, IRR seems a little bit complicated, but I'm here to tell you that it's really not. So all IRR is a way that we can work out what the rate of return is on a project or an investment. The reason it's called internal, so internal rate of return, is because it excludes all external factors such as inflation or interest rates. So in short, all IRR is a way of basically seeing the profitability of a single investment or project. And the difference between what NPV is, so net present value, and IRR, is that the IRR will tell you the discount rate that basically makes the net present value equal zero. So when we're talking about net present value, all we mean is the expected annual return that you will receive on a project or investment minus your original investment. So say if over 3 years you receive £1,500 back, but your initial investment was £1,500, then at that point the net present value overall is zero. So whatever discount rate was used in the calculation to provide the present value in the first place will be the IRR. The higher the IRR, so the higher the internal rate of return on a single project, and the higher amount by which it exceeds the cost of capital, the higher the net cash flows will be to a company. Now, just like NPV, IRR takes into account the time value of money. And all the time value of money is that basically money in the hand today is worth more than it is tomorrow. So say if you're looking at two projects, for example, and in the first project you receive your money back quicker than in the second project, then you're probably more likely going to choose the first project, because when you receive that money back quicker, you've got more options and more opportunities to do what you will with that money and possibly invest it elsewhere. When you're looking at what the discount rate is that will make net present value zero, so this internal rate of return, and say if you're looking at a company who's got, say, a required rate of return of 9%, but your IRR is 10%, then you're going to go ahead and invest into that project. So we're just going to jump onto the computer very quickly so I can show you an example of how you could work out IRR very quickly without the use of any mathematical tools or any kind of investment tools whatsoever. So I'll see you on there in a second. So here's the example that I've just pulled together on the screen here. So we've got a business that's considering a capital investment project. The accounts assistant has prepared the following net present value calculations, and here we've got a question to say what is the internal rate of return, or IRR, and show your calculations. So there's something that we can do here, and I'm going to type these out very quickly. So step one, I'm going to take a positive net present value. So I'm going to take this 15% and the 5,000. So I'm going to take this net present value here. Now step two, I'm going to go ahead and take this 25% and this 200, because that's where this falls into a negative net present value. So I know that somewhere between 15% and 25% is our IRR. It's probably going to be close to, I don't know, about 24, maybe 23 at a guess, but let's work it out. So if I've got 200 plus 5,000, so I'm adding this and this together, but I'm not doing 5,000 minus 200, I'm doing 5,000 plus 200. Sure that we get that spelling right. Now step three, what I'm going to do is take these two percentages and minus them from each other. I'm going to do 25 minus 15, so that gives me 10. Now step four, I could have changed these around, so it doesn't matter if you do step 4 or step 3 first, but I'm going to take this positive net present value figure and divide it by the two that we added together. And then step 5, I'm going to take this figure I've just worked out and I'm going to times that by this 10, and that gives me 9.615384615. And then step 6, I'm going to go ahead and take my 15, so my lower cost of capital percentage here, and add it on to this 9 that we've got, and yep, you can see here that the internal rate of return is 24.62%. So I hope you found all of that useful. Do consider subscribing as always, and I shall see you on the next video.